So in today's video, I want to share with you 5 common real estate investment mistakes and how to avoid them. Are you ready? All right, here we go. Mistake number 1, they never get started. This is a problem that most real estate investors have. They never get started. Like, I've been doing this for 20 years, either working with real estate investors or being the real estate investors. And I can tell you there have been hundreds and hundreds and hundreds of people that I've heard say, well, I'm finna get started. I'm in the process of doing it. I'm strategizing. I'm working with my lender. I'm waiting for the market to go down. This, that, and the other. You know what they're doing? They're procrastinating, and they are participating in the first of the 5 common mistakes that a lot of real estate investors make. They never get started. So if you are struggling with paralysis of analysis, if you struggle with procrastination, if you're one of those ones who are, who gets uncomfortable and intimidated by the fact that you're getting ready to put all your money up, or you don't know if you're going to lose it all and you got kids, family, or you just don't have the time, whatever the excuses, that's what it really is. But I'll say respectfully, whatever the reasons are that are keeping you from getting started, then guess what? Stop focusing on being the end buyer. A lot of times you get intimidated because you feel like I have to be the end buyer. I have to be the one buying the real estate. This is how you can avoid not getting started. You can become a deal finder. All you have to do is build a relationship with real estate investors and ask them what their buy box is, what their criteria is, okay? And when you find out what their criteria is, you match that up with people that you might know who want to sell their home or who may be selling their home. And if you get the names, the numbers, the email addresses, and a little information about the properties, ask the real estate investor, will they give you a finder's fee? Maybe you can step it up a little bit and be a wholesaler. Perhaps you have a little money, you could be a private money lender. Or you can assist an investor with other things that you're good at doing that brings value to them to make their life a little bit easier. Whatever it is, you got to do what you got to do so you don't get caught up in the paralysis of analysis. You got to get started. Mistake number 2, they take shortcuts on due diligence. You don't want to take shortcuts when it comes to real estate investing. 3 main areas of due diligence. You have legal due diligence, you have financial due diligence, and you have physical due diligence. Don't take shortcuts on your due diligence. Now let me explain to you what I mean by each of these. Legal due diligence begins with you having the right entity structure. This is why I, as a business consultant, talk so much about holding companies. You want a holding company, you want a parent company, and you want to put your real estate investment company under your holding company so that you're able to operate your real estate investing, but you still have a parent company that may own, control, and hold other assets. That's how you want to do it. If you don't understand holding companies, you definitely got to reach out to me. I'll give you the game on that. Or just watch my YouTube channel. We have a couple thousand videos on holding companies. But your legal due diligence is about having the right entity structure. It's about having the right attorneys and professionals who understand the laws that govern what you're doing in the area that you're doing it in. You don't want to just download all these documents and forms off the internet and you think just because some guru on the other side of the world said they're going to work, they ain't going to work if they're not legally compliant with the laws that govern where you live and where you're doing real estate, okay? Second area of due diligence is finances. You want to do your financial due diligence. You want to make sure that the deal makes financial sense. You don't want to be putting your money in a deal that's going to take your money. You also want to do physical due diligence. This is a very common mistake because if they're not doing the due diligence, real estate investors, on that property, you could find yourself in a world of trouble, especially if it's a distressed property and especially if your real estate investing is creative, like subject to owner finance or anything in that world. You have to do your due diligence. And the way you do it is get your legal team together, get your paperwork right, make sure you understand how to underwrite deals and know the financial logistics behind properties, and make sure that you have an inspector to inspect those properties and a competent contractor who could give you quotes on how much it's going to cost to get that property to market value. Mistake number 3, they enter without an exit. Never enter a deal without knowing the exit, if that makes sense. I want to know how I'm going to get out of this deal. Are you going to F and F? That's fix and flip. Are you going to B and H? Are you going to buy and hold? Are you going to BRRRR? Whatever it is that you're going to do, which by the way, BRRRR is buy, renovate, rent, refinance, and repeat. But you need to know what your exit is before you enter the deal. Don't just be so ambitious and excited about, I got to get my first deal. I got to get this monkey off my back. And then you find out it wasn't a monkey. It was an elephant, a gorilla. And you got to live with it because now you're bankrupt. Don't do it. Make sure you know the exit before the entry. All right. That means before you get to the closing table, before you get under contract, before you start putting money out, know how you're going to exit that property, especially when it's creative, like subject to. All right. Mistake number 4. They get lazy or they give up on expansion. So sometimes real estate investors can do a deal. They do 1 through 3. All right. They become the end buyers. They don't take shortcuts. They did all their due diligence. They understood their exit strategy, and then they got this one property, and guess what happens? They either get lazy or they give up, because if you buy and hold it, you might have people who don't want to pay. Now you're going to court to try to evict people, or you had a property manager or a real estate agent that didn't do their part. They were skimming money from the top. All kind of things can happen. Or you got 2 or 3 properties and 2 HVAC systems go out, 1 roof start leaking, or you have squatters in one house. It ain't a whole lot of things that got to happen to a landlord for them to give up or for them to get lazy. This happens commonly, okay? And this is a mistake. They get lazy or they give up on expansion. Man, I ain't getting no more houses. I don't want to go no further. I'm going to just stay here. Or you get around people who convince you that you don't want to do too much. Well, you're just looking at it from a limited perspective. So how do I avoid that? Stay learning and stay growing. If you're around people who don't own real estate, you think they're going to encourage you to learn and grow, to expand, doing more? No. But if you're around people who own 10, 20, 30, 40 doors, you're going to feel like the little dog. It's like being around Great Danes and you're a little Chihuahua. You're like, man, I got to get my game up. So you got to stay learning and you got to stay growing. Mistake number 5, they miscalculate and or mismanage either capital gains, that's when you're fixing and flipping, and or cash flow. That's when you're buying and holding. So capital gains and cash flow is 2 different types of money. Okay. So when you fix and flip properties, if you don't calculate the tax responsibility and the operational responsibilities for your fix and flip business, you might go bankrupt or you might owe the IRS more than what you wanted to owe. If you mismanage cash flow because you're buying and holding, you're spending it because you think it's going to keep coming, you're going to find yourself in a lot of trouble, because all it takes is one problem to show up and it can eat up your cash flow for the next few years. So a lot of real estate investors make this mistake of either miscalculating their capital gains and or mismanaging their cash flow. So these are the 5 common mistakes I know and I've seen a lot of real estate investors make, but I'm showing you how you can avoid each 5.